everyone. Thanks for tuning into another episode of Our 2 Cents on Your Dollars. I'm James Enriquez.
I'm Alexis Villarreal.
I'm a sockless Leo Chang.
I'm James Credo, and I have socks.
And today we're going to be discussing who is managing your money, whether or not they're wearing socks. I'm sorry, teasing about that. But today we're going to talk about who's managing your money. What's their investment process? Who's building your portfolio?
Right.
But before we dive into that, I feel like there's some disclosures that need to be said.
Oh.
Anything we talk about today is not meant to disparage anybody. It's just meant to pull the curtain back a little bit to help the viewers watching this. Because I think there are a lot of misconceptions about who's managing money, how portfolios are built.
Right.
Yeah.
Yeah.
Would y'all agree?
Plethora. Yeah, absolutely.
Okay.
That's a good word. Plethora.
That's why we're here.
So I don't have to be careful with you guys, right? No disparaging comments, right?
No.
Okay.
We'll play along.
We'll
play
you
along.
didn't look at him hard enough when you asked that. At all.
I am subject to say something.
We know, yeah. For
Okay.
liability.
Okay. So I think one of the biggest misconceptions is that we have oodles and oodles of education and training on how to build a portfolio.
Yeah.
Because I know I was shocked changing careers and knowing that I just had to study for 6 weeks to pass this licensing exam, and you're ready to build a portfolio. Excuse
I
me.
remember you telling me about spending a whole Saturday doing something at the very beginning about building a portfolio, and then somebody told you that you didn't have to do it that hard.
Yeah, so that's an interesting thing I want to unpack. I'm glad you went there, because not only did I not have to do that, all I had to do was click a button for a portfolio to be built.
Yeah.
You're telling me that the software built the whole thing for you?
I'm telling you that the software with that specific firm did that one specific thing a specific way that I told it to do.
Yeah.
How about that? And we'll unpack that a little bit.
Wow.
Okay.
So did
Easy.
you actually pick the investments, or did it actually turn out to be the firm picked the investments?
That's a super good question. All right, so okay. The way it used to work is you pick a fund family,
Right.
and you pick an investment objective. You pick from a drop-down menu,
Right.
and then you click build portfolio, and this list of 8 to 10 funds pops out, all with that fund company. There you go.
It's funny because I remember studying too and going through that process and being like, wait a minute, I have this license to be able to sell all these investments and all these things. But then when I got to the first firm, they're like, you can only sell these 6 funds. These are the only options that you can utilize. All the other ones, they're not good.
Well, and I think, so we're bringing this up because I think it's worth people knowing that at that time, there was really only 2 ways to manage portfolios at that firm. There was either you built it like that and it was a commission-based thing, so built around a commission-based product, or you let the home office manage it for a fee. Not the advisor, the home office.
Right.
And furthermore, the one that was assessed a commission, we didn't have discretionary authority, which I think is a shock to most people. Because now that we have discretionary authority, and I'm talking to folks about it, they all say the same thing. They all say, well, I thought that was kind of understood. Like, don't you need that to do your job? And so
Yeah,
I think
no,
people would be surprised that some people do not have discretion.
And I would imagine that there's probably some people doing things in portfolios without actually following the proper protocols, right?
Yeah, we're not, again, no disparagement. Don't want to throw anybody under the bus. We're just trying to let
old
everybody.
Alexis.
Shots fired. Shots fired.
But you know what? Maybe we should. What is discretion?
Discretion pretty much gives you authorization to make at time decisions on behalf of the client. So we have a fiduciary responsibility to do what's in the best interest of the client. So what discretion is, it provides us the opportunity to make investment decisions at the time being of when we need to do them.
And that goes from everything from if they have a sell, which investments to sell, if they have a buy, which investments to buy, if they need to rebalance their portfolio. And so when we first started in the industry, right, you used to have conversations every time you did all those activities.
Right.
And as a practitioner, right, running a business and dealing with, a couple hundred households, when we are doing things for clients and it is a benefit for all clients, we used to have to call each and every one of them to have to do so. And so having that discretion makes it to where we can now be more uniform for all our clients, and to where you're not just picking, the top tier clients to do the alterations and changes for. You're able to make those for everybody almost on the same day. And that really makes life a lot easier and as far as managing their portfolios.
Yeah, the example I give people is, believe it or not, at the other two places that we were at, we never had discretion. So if every single client had company X stock in their portfolio and we wanted to make a change, we'd have to literally contact every single client, tell them, hey, we think you should sell this, we think you should buy this, and go into the individual account and buy and sell. So if you're a successful practice and you have a lot of clients,
That's going to take days, if not weeks.
yeah, if you even get to all of them.
If they answer the phone and call you back.
Right. And in a timely manner. Right. Yeah. So you bring up an interesting point. So if somebody doesn't call back or I don't get to talk to them, I can't place that trade.
Right.
Then by the time they get back to you and be like, nah, it's actually don't want to do that anymore.
Right. Yeah.
Like it's actually, that was weeks ago. Right. Now, actually, let's probably keep it or whatever. It happens. It happens.
Yeah. Right. Yeah. Yeah. People get busy, whatever.
Right.
But I think people would be surprised to know that if you don't have discretion, you can't place those trades.
Right.
And so we can't really do what we believe is in the best interest of the client.
And you have limited time to do it too. I mean, the stock market closes at 3 Central. And so if you're having to call every client, already you're having inconsistent returns across your client portfolios. Even if you are doing it, the right way and you're calling every single client, which could take days and weeks, all of them are getting different pricing.
Right.
Yeah. So.
Right.
Okay. So earlier I mentioned there was 2 ways. There's home office and a portfolio that the software could tell you what to invest in. There was a recent article that came out that home office portfolios outperform financial advisors.
Yes.
So in other words, I'm a financial advisor. I put together a portfolio based on my investment philosophy, my investment research.
Are you a CFA?
Oh, okay. Yeah, I'm glad you asked that. So we're going to talk about that in a second. But so if I do that, what this article stated is the majority of financial advisors that do that underperform a model from their home office.
Right.
It goes back to what he's talking about, right? In doing such a thing, right, you're creating these portfolios, and so you're taking time to do some research and due diligence. So you're taking time away from trading, taking it away from other activities that need to be done as far as being a financial advisor. And again, right, I have a finance degree. I have different securities license. I have different accreditations. Does that make me a certified financial analyst to be able to construct a portfolio for the current times, and am I going to be able to keep up with it as times change? And I think that having a long look in the mirror, right, being realistic with myself is that, right, not efficiently, not to do it over a large practice. For my own account, maybe, but for everyone's accounts, it's difficult.
We're just kidding, compliance, not on our own accounts.
Yeah. At the end of the day, too, there's so many things that we take into consideration as far as whether we take on the role of the portfolio management or we outsource it and have somebody else take on that role. And James' favorite word, tax implications, taxes, play a big part in that because the action of buying and selling a security, if it's in a non-retirement account, will cause certain tax implications for individuals. So when you outsource the portfolio management, depending on who you're outsourcing it to, the tax implications are not taken into account. And so when we rely on those third parties to do the portfolio management, the tax implications for an individual who is more tax sensitive could play a larger part and be more detrimental than just the small marginal difference in the portfolio rate of return, right? So we take that into consideration in some circumstances of whether, hey, we want to let them just handle that, and whether the client is comfortable with someone else handling the portfolio management, or we're going to take it on ourselves, construct a portfolio that's more tax sensitive to what their needs are, and handle that in-house.
By the way, my heart skipped a beat when you said taxes.
Oh, no.
So thank
I
you.
saw you get a little clammy.
Yeah. Butterflies fluttering. Okay, so outsourcing. I love that you said that. What are some things that we should consider when outsourcing? Or what does outsourcing even mean?
Yeah, just going back to, you talked about home office portfolios outperforming advisors. At an earlier episode, we talked about that in the CFP exam, that a larger portion of the exam is now focused on behavioral finance. And as practitioners, we always like to say that, managing your emotions is key to reaching your objectives, but it's also key for financial advisors to manage their own emotions when managing portfolios. And that's the problem. That's why every broker dealer or large investment firm, when they look at advisor models versus the in-house company models, those are outperforming, because as advisors, we also have emotions. And we all have our own biases. And it shows in performances. And I think that's something that we have to mention, and that's why, as much as possible, you need to have a consistent process. And you do that by outsourcing your investment management to either your home office or a third party, where you have a whole team of professionals. The majority of them are usually CFAs, and all they do is make investment decisions, and they have a committee, and it's a consistent process, versus a solo practitioner that's managing so many households, and each house, right, a whole team, right? You have so many households, you might not even have discretion. So the experience of your clients across the board are so different. Even if on paper they're supposed to have the same portfolio based on risk, when you look, it's all over the place. And that's kind of why we've decided as a team that for investment planning, we've outsourced it to professionals. And because we truly believe we want to have more time doing financial planning stuff, where we actually think that's where you can make a difference, and actually, actual results that make a huge difference in our clients' lives. So.
And I think some other ways you can outsource too is risk, right? There's some times where some individuals might be risk averse, right? This is where you can implement maybe some insurance companies, do some different factors to where you're still trying to give some investment objectives, but yet you're putting some guardrails behind there to be able to really help the client be at ease with some of these things. And so I think those are some different ways of outsourcing.
If you add, to clarify to the audience too, CFA, it's a chartered financial analyst.
Yeah.
So these are individuals that go through a very rigorous vetting and studying and process to be qualified to make analyze investments and make investment decisions for portfolios. So
yeah, their clients are the actual investment companies that they're doing. They don't deal with clients. All they're dealing is just portfolio construction. That is their job.
Yeah, they're not face to face with the clients like we are.
Right.
They're just looking at the trends and making those decisions.
Right.
Yeah.
Yeah.
Well, for clarification, some financial advisors do hold a CFA.
Yep.
And some large ensemble practices, like
Have
financial
in-house.
will have in-house CFAs putting together portfolios.
Right.
So I think that should be two questions, at least two questions that every client should ask. Who is actually building my portfolio?
Right.
You or a third party,
Yep.
or including your home office?
Right.
And if it is you, Mr. Advisor,
Right.
what are your qualifications in education?
Yeah. What qualifies you to do this at the end of the day?
Yeah, and I don't mean that in a mean way. I think like I said, going back to the very beginning, I think some people would be surprised that it just takes 6 weeks of studying to pass a licensing exam to be full forced. I can build a portfolio.
Yeah.
Or better yet, I remember when I first got into it, I passed a life insurance exam, and we're selling life insurance products as investments, and it was a kind of a misconception. I felt like once you started to dig down into the weeds of it, of really what was the actual investment, what was actually happening, what was going on. And so I think making sure that people understand what is the actual vehicle that you're using, and is it exactly what you think it is.
Yeah. Okay. Going back to the outsourcing piece.
Yep.
I think people would find it interesting to know that some firms, some big broker-dealer firms, actually don't even have an option to hire a third-party money manager. At least not the way they're probably thinking about it. What are some considerations that clients should be thinking about when outsourcing? Like, I've had people ask me this, right? So if I'm involving a third party, what's the cost for that?
Right.
Yeah, cost is obviously a factor in determining who that may be. I would also say if they have tax sensitive products as well too, because most of our clients have an arrangement of qualified and non-qualified assets. So that third party money manager, whether they're investing in instruments that are more tax sensitive or not, that play a benefit in your non-qualified assets, that's an important part. Also, are they strategic investment style? So understanding their investment style, understanding their investment strategy. If it's something that's a little bit more comfortable or that aligns more with your philosophy as well too, because some managers play a very more of a passive strategy, right? Where what they're investing in, they hold it and they buy it and they hold it for a longer period of time. Some are a little bit more active, right? So they have a philosophy and a strategy as far as trying to maximize returns by being a little bit more dynamic, and taking into account market trends, different things, right? So those are different factors, I would say, that you may want to ask as far as what you're trying to accomplish and what your goals are specifically.
Yeah, those are awesome points. And the main thing too is just asking your all-in fees. How much is the advisor getting paid? How much is the practitioner getting paid? And are the underlying investments that you're using, are they efficient also from an expense perspective? Because those funds also have their own internal expense ratios. So you have to ask all in, how much am I paying you?
Simple question is, why did you choose those investments? Why did you pick those for me?
Right.
Why are these in this account? Why is that in that account, right? I think those are simple questions that should be asked. Those are simple answers that we should have for them, right? Because, at the very beginning, if someone was a high risk, or not even high risk, maybe in the middle of the road, right, where they had, they weren't all stocks and they weren't all bonds. They were some sort of in the middle mix. As a new advisor, right, I would just do that for all their portfolios, not understanding, right, that placement had a big deal with that. And so, right, going back to how do you choose the investments and which accounts to put them into, that's all part of I think, the questions that should be asked.
Yeah. Piggyback off the fees thing, I think it's worth knowing that depending on the firm that clients are investing with, the fee for the third-party money manager could be included in their asset under management fee, and it might be coming out of the advisor's pocket, or not at all, or the advisor is passing along that extra fee to the client. And I think that's worth knowing because that could create a bias or it could create a bias.
Yeah.
Really
I remember
good
some of the
point.
complaints that would happen in one of the previous firms, right, was the fact that you could only utilize certain money managers. And, right, the complaint that would happen was often, well, yeah, you guys recommend those because they help fund so many of your office meetings, or they help provide lunches, dinners. There's all sorts of other factors that people will kind of throw in there. And, again, it kind of creates a conflict, right? And I think that, you want to try to avoid as many conflicts as you can. You want to be as open, have as open architecture as possible, right? So that way you're not having to deal with those things. You're literally looking out for the best investments, best interest of the client.
I want to get back to, we talked about CFA. I don't know that you necessarily need to be a CFA to have discretion or build portfolios. And this article that I referenced earlier talked about 30% of advisors at this one specific firm those were the only advisors that were qualified to have discretion.
Well, I think I recently had that at a previous firm where not many individuals had discretion, but yet I did. I had a APMA accreditation, and that was to build out portfolios. And I remember when I got the accreditation and I realized how small of a number of individuals actually had that APMA accreditation. At the very beginning, I thought that I had, I was unique, not realizing that just not a lot of the firms require that. It was just kind of a firm specific
I see.
accreditation that I had to acquire, and
Right.
so. It was a unique thing. At the one before, the previous firm, the first firm I was at, the discretion really was handled by the home office, right? They did all the changes on our own, but it's been an evolution to understand how that actually works.
That's it, and that's a liability thing. That's really with the broker dealer in that sense. I'm sorry, like it just you have so many advisors working for you, and just to allow all of these individuals to make these decisions, on behalf of the client, where no matter what, we're supposed to take into account and play that fiduciary role and do what's in the best interest of the client. But a lot of these broker dealers do not want to take on that liability, just saying, yeah, if the client says go ahead, do whatever you want, go ahead and do whatever you want, right? And so they have those requirements. They want to make sure that you meet these certain standards and have this, accreditation or background, or not even give discretion whatsoever. But I go back to the efficiencies of having that now and what that does for our practice. And in most circumstances, clients didn't even realize that we never had it in the first place. But that doesn't mean that just because we have discretion that I want to build the portfolio. Anyways, it's nice to have it as, in our back pocket in those circumstances where we do have to make decisions quickly.
Mm-hmm.
But there's still a level of efficiency with outsourcing this process.
Yeah. I'll pick on myself, so I'm not picking on anybody else. I think just because you have discretion doesn't make you just because you qualify to have discretion doesn't make you qualified to build portfolios.
Right.
I mean, a lot of my clients have heard me say this, but who am I to think that James Enriquez in McAllen, Texas, that sits with clients every single day, is going to be able to build a portfolio better than these CFAs, Ivy League educated, that all they do is pour over spreadsheets every single day, sit on earnings calls, maybe even
in the manufacturing shops, just talking with executives.
Right.
That's what they're doing.
Yeah, exactly.
Yeah.
I think it's just understanding that their clients are the actual investments, the actual companies themselves, where we are having to try to manage clients and client expectations, their taxes, everything else that comes along with it. And, it's very unrealistic to think that, right, we can do all, right? And I think that's the part that as an advisor, it took some time to look in the mirror and realize, right, I cannot do everything.
Okay. So, all right. So if that's what the literature says, that advisors tend to underperform home office portfolios. Why are advisors still trying to manage portfolios?
Because I can time the market. I can do it. I can beat the market.
I'm different.
I'm different, right? This time I'm right.
I'm him.
I'm him, right? All these selections that are coming up, right? It's different this time, right? It's always different. There's always some sort of reason why they think
It's
they
all
can.
over the place. From what I've seen, it's anything from they don't even probably know that statistically speaking, most advisors are underperforming. They might not even know that. All the way to they feel like if they're the ones actually placing the trade manually, that they're working for their clients, even though in terms of money, their clients have less money as if they just outsourced it.
Yeah, they're just selling the process, right?
It's feeling. It's also there's a fear that if the portfolio looks cookie cutter, the client might see it and say, what are you doing for me? Versus a portfolio that has so many individual holdings, it looks very sexy. But if you actually look at the returns, it's still underperforming, but it looks like you're working.
Mm-hmm.
So it's a feeling of also that you feel like you have to do that because that's your only value.
Mm-hmm.
And to me, when I see that really means either you don't really know the value of financial planning or you just don't offer it. That's why you have to focus so much on that, is my opinion. So
Yeah. Some guys or ladies have egos, right? And they just think
Right.
they can they can do it. And at the end of the day, more than likely, they haven't taken the time to look at that information, that data, to come to the realization, like, you can't. You really can't. So
You can, you're just going to underperform, right? And I think, again, it's that looking in the mirror and being honest with yourself and taking a hard line with what did the numbers actually say. And I think, again, going back to what the research says, right, is that we're not going to do as good as somebody that's all they're doing.
Yeah, I had this thought the other day as I was watching Thursday Night Football and analytics come up on the side of my screen.
Yeah.
Oh, they should go for it right here.
Right.
I'm like, man, analytics.
when Aaron
Yeah.
Rodgers was carving it up, yep.
Well, he's on my fantasy team, so I'll go with that. So I feel like it took a little bit, but I think we're okay with analytics. So if you look at the analytics and say, all right, I'm more than likely going to underperform.
Right.
Maybe I should outsource.
Right.
The question I ask the client at this point is, right, hey, I can do it, but we're probably going to have less money. If we outsource it, you're going to have more money. What do you want to do?
It's tough from a marketing perspective, because if you're truly data driven, that means you shouldn't even rebalance your portfolios. But then the statement's going to show you haven't done anything for the client. And so, because I've had calls in my career, and I can tell someone has been talking to my client, because based on the question that they're asking, hey, James, when was the last time you placed a transaction? And I would say, I don't know, we try to do it once a year, once or twice a year, based on your model. Shouldn't I have more transactions? So there's this idea that the more transactions you place, the better the return,
Know that you're working.
and that it looks like you're working. And this is where you have to, believe in the stats and believe in your culture, where you say, actually, based on the data that we see, the less transactions you place, the less rebalancing you place, the better actually your portfolio will be. But it's going to look like your advisor is not working. So what do you want? Do you want a sexier portfolio with more transactions, but you have less money? But a plain Jane that actually has a consistent process, and you actually have more money at the end. So
I work with some really close friends I've had relationships for years. And early on in our relationships, we would construct portfolios, and I would make mutual fund recommendations. And young guys making money, they want to try to make a quick dollar. So they want equities in the portfolio. And my pushback was, I'm not a professional money manager. So, I don't know exactly when to buy and when to sell these, but if you guys want to implement these, let's do that. But what we're going to do is we're going to take these equity positions you want to buy, and we're going to put them over here in this portfolio. And we're going to take the mutual funds that we have all the research on and that we know have tried and true, and we're going to put them over here. Let's see what they do over the next couple of years, right? And to this day, my buddies have a running joke, mutual fund Leo, knowing that those mutual funds killed their equity portfolios. Yeah. Killed. Yeah. And so, to his point, like, there doesn't need to be this elaborate, expansive, sexy type of investment strategy to have consistent quality rate of return over time. And for us, what we've done and what we've come to realize is we can do that and not have to do it ourselves either. Like, just completely, rely on the professionals to be able to do that for us.
But that's not to be lazy, right? It's we don't have to do it, so we can focus
utilize
on other
the time
things.
to do what we feel like we provide our most value on, and that's the planning.
Right. The taxes. Yeah, you know what? It reminds me when you said when you were talking, it reminded me of what I tell some clients. Right? It's like I don't have to outrun the bear. I just got to outrun the last guy, right?
Yeah.
And I say that and I say that in response to when clients say, well, because we do a lot of ETFs, right?
Yeah.
So, well, if I'm just gonna go by the ETFs, like, what I need you for,
Right.
basically.
How much are you going to put in each one of these? which ones are you going to build out?
Well,
right?
there's that, right? Okay, there's that. But let's say I kept it. We don't keep it this simple. But let's say we keep it as simple. Hey, 3 funds. That's it. Here you go. You'll be fine. I don't need to outperform the benchmark because it's kind of what these people will say. Something like that, right? That you're just going to match the benchmark returns. It's like, well, I don't need to outperform the benchmark. I just need to outperform the advisor that thinks he can and outperform you that's going to build your portfolio of equities. And sorry, but this ETF is probably going to do that.
Yeah. It's very interesting because, most advisors would know that mutual fund managers can't outperform their own benchmark in a long-term basis, on a 5 to 10 year basis.
Oh, yeah.
So even professional money managers,
Hedge fund managers
cannot outperform their benchmarks in the long term. Yet we try our very best to hold on to be able to control the investment management side of our practice, when there's other more important things that you can actually do for the client, and by outsourcing, you're actually going to have consistent returns for your client base. So
Sounds horrible.
I mean, in next episodes, I think we should give actual financial planning examples why we try our best to have less time with that investment management, so that people can see, oh, okay, I see why they're kind of doing that. So
Yeah. All right, little teaser. Okay.
just a little.
Well, yeah. Well, I mean,
Oh, he's gonna throw one in.
Yeah.
no. What I'm saying.
I thought we were wrapping up, but okay.
One of the episodes we go into detail as far as just what is financial planning and the benefits of that. But
Yeah.
that's where we want to spend most of our time. That's where our value add is. That's where our CFP designations come into place. That's why none of us have CFA designations, because we really want to focus specifically on that value add, right? So we want to spend more time and energy, and we want to allocate that time and energy on being able to provide that service at a really, really high level. And we know we can continue to provide the investment service at a very high level without having to do it in-house. Being able to have those resources to do that is a huge benefit. It's a huge benefit.
Makes it a lot easier for us too, right? When we're just having to really look and research fund managers from a overall as companies, instead of having to go into a bunch of different ones. It just makes it a little bit easier for us to manage, and also to, again, go back to Credo's point, consistent returns.
Yeah, one thing we didn't mention is that a value add that we have is the fact that we have to still pick the fund manager, right? There are so many fund managers out there, right? So many. So we still have to analyze the fund managers and determine the appropriateness of
which
what they're
models to
doing,
use.
what type of model to use, and how that makes sense for the client, right? So it's not like we're just throwing a dart at a board and saying, oh, let's pick them. There's still a process. So even if you did want to go out and do it yourself, there's still a process that goes into determining who to use, right?
Yeah, I think there's a misconception. We talked about home office portfolios. I think some people think that a big brokerage firm, actually manages the portfolios for everybody. I think y'all experienced that.
Yep.
Right.
Yeah.
Yeah.
Clients in a transition prior in the career, clients made that assumption, and they couldn't have been farther from the truth. Especially too, because I thought that I could do it myself. So a lot of what we were doing was myself constructing portfolios at that time.
But with limitations, though.
Yeah, with limitations, but their assumption was that the firm was doing all that, and I was like, it should have been the firm. Like, I wish it was, but it actually wasn't at the time. It was me making those decisions, and so in most circumstances, it's a third party that's doing that. It's not the broker dealer themselves. In some circumstances, it is. It can be, right? But I would say in most circumstances, it really isn't.
Yeah, so I think to make it, so people can understand, they try to make it easy, and I think they think that, okay, you're with this firm, so if I go to you or I go to some other practice with that firm, I'm going to get the same exact thing, just like if I were to go to that burger chain, I'd get the same exact product.
Quarter pounder tastes the same everywhere.
Right, but that mutual fund doesn't taste the same everywhere, right? So So
Very different, very different.
Right. So I think that's important to know too, and that's why it's important to ask those two questions that I
Yeah, because
mentioned
I
earlier.
always thought it was interesting from one firm to the other firm, same fund family, but yet all of a sudden it's like the playbook opened. It's like now we had access to all these other things that were there in the same fund family, but for whatever reason there's restrictions. So it's not always going to be the same for whatever reason, right? Each broker dealer has different flexibility on what the advisor can and can't do.
Or you can completely outsource that service to a third party, and not only are they creating the asset allocation, the model, and the funds, they're actually placing the trades for you as well. So,
Yeah, some of them we actually have to actually place the trades ourselves, and some of them, as soon as money comes in, they automatically allocate it. As soon as money is coming out, they automatically do it. So there's two. I mean, in our scenario now, right, we actually have the client has a choice, right, for us to do it, click on the buttons to place the trades, or we can have it completely outsourced.
Yeah, and to be clear, the third party that we've decided to use as a firm, they're giving us the recommendations, but we're having to still place the transactions. And we have many options where we can just use a third party that's doing it all. But the reason why we've decided to stick with this third party, even we're trying to be as efficient as we can, but we still pick this third party because of their track record, their performance, and also we still have some legacy holdings that we're not just going to sell and move them into this third party or model because, you know, it can generate capital gains. So I just want to make sure that, you know, everyone understands that, yes, efficiency is so important because we want to do more financial planning stuff, but we're just not going to do it if it's detrimental to the client. So,
Yeah. Yeah, good stuff. I think we just want to give everybody an idea of how we did it so they can think about their relationship with their advisor, or if they're looking for an advisor, the questions to ask, or, you know.
Yeah.
Yeah. Okay.
What is their process, right? How are they doing this?
Yeah. Is it repeatable?
Yeah.
Yeah.
Okay. Well, thanks again for tuning into another episode of Our 2 Cents on Your Dollars.
We hope you found these tips both useful and insightful.
if you are looking for more videos like this, like and subscribe right here.
Look to see you on the next video. Have a good one.
See you.
Peace.